Welcome to this Talk Tickers deep dive. Our mission today, and this is a big one, is to slash through the jargon, the noise, and just the sheer volume of data in Core Scientific's Q2 2026 earnings call.
Yeah, we're looking at ticker symbol CORZ today.
Right. And the source material on the table includes the full, unedited transcript from management. So we're talking CDO Adam Sullivan, CFO Jim Nygaard, and COO Matt Brown.
And what we are examining here is, honestly, one of the most radical corporate pivots in recent public market history.
Oh, absolutely. I mean, you have this former cryptocurrency mining heavyweight completely transforming itself into an AI infrastructure utility.
It's a massive shift. The overarching theme here is this transition from a highly speculative, really volatile revenue model into something that basically resembles a blue chip infrastructure play.
Yeah, exactly. And we are going to break down the headline numbers, dissect the underlying story behind these multi-billion-dollar deals, look at management's future guidance, and, deliver a bottom line assessment on what this actually means for your portfolio.
Because we have the raw data now. We have the details on massive new capacity deployments, these long-term commercial real estate contracts, and just a total reimagining of how they source and monetize electrical power.
To really grasp the magnitude of what we're looking at in these earnings, you kind of have to think about like a wildcat oil driller.
Okay, I like this analogy.
Right. So picture an operation out in the desert. They're sinking millions of dollars into the ground based on, geological surveys and raw hope. The financial profile is just the literal definition of boom and bust.
Slightly cyclical.
Exactly. If you strike a gusher when global crude prices are high, you print money. But if you hit dry dirt, or if, say, OPEC floods the market and the price of crude just tanks,
you're left holding the bag.
You're left holding the bag on a fleet of useless, depreciating, rusty equipment. You have massive fixed costs and wildly unpredictable revenue.
Because the mechanism driving that volatility is a total lack of pricing power. A wildcat driller is completely at the mercy of a global commodity market. They cannot control the price of the asset they're extracting, and they definitely can't control the overarching supply dynamics. So the revenue just fluctuates violently from quarter to quarter.
Which makes long-term capital allocation basically impossible.
Right. Incredibly difficult.
So keep that wildcat driller in mind. Because what Core Scientific announced in this Q2 call is the equivalent of that driller waking up, looking at those volatile rigs, and deciding to just trade them all in.
Yeah, and not for more efficient drill bits either.
No. They are trading them in to build a federally backed toll road. They are converting their operations into a system where some of the largest, most capitalized technology companies on Earth have legally committed to paying them a fixed escalating fee.
Every single day.
Every single day for the next 15 years, regardless of broader macroeconomic chaos.
It's wild.
Okay, let's unpack this, because the data points from Q2 anchor everything we're going to discuss about this pivot.
And these figures are the empirical proof that this pivot is actually executing. It's not just, existing in some glossy investor presentation anymore.
Right. This is real. Let's fire off the crucial numbers straight from the transcript. First up, JAP colocation revenue hit $137 million for the quarter.
Which management noted was a very significant sequential jump.
Massive jump. Second, and arguably the most important operational metric here, they are currently billing for 437 megawatts of capacity.
Let's contextualize that scale for a second.
Please do.
That is nearly 200 megawatts more than they were billing for at the end of Q1.
Wow.
So we are looking at almost a 100% increase in capacity delivery in a single 3-month period.
That is just staggering speed. But it also means traditional metrics are kind of useless here.
Exactly. That 437 megawatt figure is the pulse of the company right now. In the high growth infrastructure sector, if you try to apply traditional mature company valuation metrics like earnings per share, you are going to severely misread the board.
Because they're in a hyper growth phase.
Right. Core Scientific is aggressively reinvesting massive amounts of capital. The immediate EPS is totally suppressed by depreciation and reinvestment. The metric that actually dictates their enterprise value is that billable capacity.
So that 437 megawatts generating $137 million in GAAP revenue, that represents the stabilization of their financial profile.
Precisely. When they were entirely reliant on Bitcoin mining, their revenue fluctuated based on variables they couldn't control. The spot price of Bitcoin and the global network hash rate.
The wildcat driller.
Exactly. Now, that $137 million represents steady landlord rent checks from tech companies leasing specialized data center space. But and this is a big but, we need to look closely at how that revenue is recorded.
Right, because GAAP accounting gets weird with real estate.
Very weird. Under generally accepted accounting principles, revenue from long-term contracts, like their existing 12-year lease with CoreWeave, must be recognized on a straight-line basis.
So translate that for us.
Basically, if a contract is worth $1.2 billion over 12 years, GAAP requires the company to divide that total evenly. So they report $100 million in revenue every year, or $25 million a quarter.
Regardless of the actual cash changing hands at that specific moment?
Exactly. The mechanism behind GAAP straight-line accounting is designed to prevent companies from, manipulating their earnings by front-loading or back-loading cash payments.
Yeah.
But in the case of long-term infrastructure leases, it creates this fascinating discrepancy between the income statement and the cash flow statement, because these contracts have annual financial escalators built into them.
Ah, the inflation hedge.
Right. A tenant might pay $20 million in year one, but because of a 2.5% annual escalator, they will be paying significantly more by year 10.
So because GAAP requires them to average it out, Core Scientific is effectively pulling those higher future revenues forward into their current reporting.
Yes. It inflates the GAAP margins today compared to the actual hard cash they are collecting this exact quarter.
And the CFO addressed this, right?
He did. Jim Nygaard dedicated a significant portion of his prepared remarks to this exact dynamic. He stressed that management tracks the health of the business on a cash basis, not just GAAP.
Which makes sense.
But even when you strip away that straight-line accounting effect, the underlying reality is just the creation of extreme financial visibility. The escalators are locked in. The tenant is locked in. The revenue floor is set for the next decade.
Okay, so the revenue side is stabilizing. But I'm looking at the expense side of the ledger, and there's a number here that I think warrants some real scrutiny.
Hit me.
Cash SG&A selling general and administrative expenses came in at roughly $36 million. That is a $4 million sequential increase from the previous quarter.
Okay, yes.
For a company attempting to scale a massive infrastructure pipeline, any unexpected inflation in corporate overhead is a huge warning sign. I mean, if they are just absorbing that new rent money by inflating the executive suite, or if they're losing control of administrative costs, the whole model falls apart.
It's a fair concern. But the source material provides a very clear breakdown of that specific $4 million bump. It was not driven by systemic bloat or like a sudden hiring spree in middle management.
Okay, then what was it?
The increase was primarily driven by one-time professional fees associated with their recent debt financing initiatives.
Ah, the bankers.
Exactly. When a company is raising the billions of dollars in capital required to build out gigawatts of power infrastructure, they are executing incredibly complex financial transactions. You need armies of specialized lawyers, investment bankers, financial auditors.
So management views that $36 million as an anomaly. They expect it to drop back down. Nygaard stated they view the low $30 million range as a reasonable quarterly baseline moving forward.
He did.
But, and let me push back on that projection a little bit. They added this caveat, noting there might be some variability as they make targeted investments to support growth. In the AI infrastructure space right now, top-tier engineering talent, I mean, the people who actually know how to design liquid cooling systems for high-density GPU clusters, they are demanding astronomical salaries. Is it actually realistic for them to keep overhead perfectly flat in the low 30s while trying to scale from 400 megawatts to over a gigawatt?
Honestly, it is highly unlikely that SG&A remains permanently pegged at $30 million. The talent war in data center engineering is absolutely fierce right now. To execute their pipeline, they will have to acquire premium operational talent.
So margins will take a hit.
Not necessarily. The concept we need to focus on here is operating leverage.
Yeah.
Even if their SG&A creeps up to $40 million or $45 million over the next 2 years, just to retain elite engineers, their high-margin colocation revenue is scaling by hundreds of millions of dollars.
Right. The revenue is growing way faster than the overhead.
Exactly. Once the base corporate infrastructure is in place, it doesn't cost twice as much in administrative overhead to manage a 1,000 megawatt portfolio versus a 500 megawatt portfolio. The vast majority of that incremental revenue just drops straight down to the bottom line.
Okay, that makes sense. Now here's where it gets really interesting. The $137 million in revenue and the CoreWeave execution were solid, But the absolute centerpiece of this earnings call was the formal announcement of a commercial partnership with AMD.
This was massive.
This isn't just a tenant signing a lease. This is a market-defining transaction.
Right.
Let's lay out the raw data on this deal. It is a 15-year agreement. The base contracted revenue is worth more than $14 billion over that lifespan.
Which is just an unbelievable figure.
It really is. And it includes those 2.5% annual escalators we discussed to hedge against inflation. In exchange, Core Scientific is committing to deliver 530 megawatts of power across 5 different sites.
But contextualize 530 megawatts for you. That is roughly enough electricity to power 500,000 residential homes. And it is being entirely dedicated to the most advanced AI workloads on the planet. This single transaction represents one of the largest infrastructure deals announced among any of their peers.
Adam Sullivan, the CEO, made a very specific point about their development strategy leading up to this deal, too. He highlighted that Core Scientific started development and construction across multiple locations long before the AMD contract was fully negotiated or even signed.
They were building on spec.
Yeah, pouring concrete and ordering electrical equipment without a signed tenant.
That strategy reveals a really deep understanding of the current AI bottleneck. In the hyperscaler space right now, speed to market is the ultimate currency.
Because everyone wants their chips plugged in yesterday.
Exactly. If a data center developer waits until a contract is signed to start the permitting process, break ground, and order high-voltage transformers, they are instantly 2 to 3 years behind. The supply chain for critical electrical components is severely backlogged globally.
So Core spent the previous year securing that long lead equipment and preparing the site pads.
Right. AMD chose them because they could actually deliver the capacity in 2027 rather than 2029.
Let's break down the structure of that 530 megawatts, because it's divided into 2 very distinct commercial setups, which I thought was fascinating.
It's a very clever structure.
So approximately 380 megawatts are going directly to AMD across 3 sites, Pecos, Hunt, and Muskogee. This is structured as a triple net lease.
Okay, let's translate that for anyone who doesn't spend their days reading commercial real estate contracts.
Please.
A triple net lease, which is often just written as NNN, means the tenant agrees to pay all real estate taxes, building insurance, and maintenance costs on the property, in addition to the base rent and utility expenses.
So Core Scientific essentially hands over the keys to the shell and the power supply, and AMD takes on the entire operational burden of running the facility.
Exactly. The mechanism of a triple net lease is designed to insulate the landlord from variable cost inflation.
Like if taxes go up.
Right. If the local municipality decides to double property taxes, or if the cost of industrial HVAC maintenance just skyrockets, AMD absorbs that financial impact, not Core Scientific. It transforms the revenue stream into something resembling like a fixed income bond yield. The margins are fiercely protected.
Okay, so that covers the 380 megawatts. But the remaining 150 megawatts, located across their Auburn and Dalton campuses, this is where the financial engineering gets really cool. This capacity is going to support an unnamed neocloud provider.
What's fascinating here is how secretive they were about it.
Oh, yeah. During the Q&A portion of the call, an analyst actively tried to fish for details on the size and scope of this neocloud, and Adam Sullivan just flatly refused to name them.
But he did detail the lease structure.
He did. It is a modified gross lease, meaning Core Scientific will retain some of the operating expenses, unlike the triple net sites. But more importantly, AMD is providing full credit support for this mystery neocloud tenant for the entire 15-year term.
And the financial mechanics of that credit support are the linchpin of this entire 150 megawatt tranche.
How so?
Well, a neocloud provider is typically a newer, highly specialized company. They offer GPU compute as a service, basically renting out processing power to AI startups or researchers. While they might be highly profitable right now, they do not have the decades-long balance sheet or the investment-grade credit rating of a legacy tech giant like AMD.
So they're a credit risk.
Right. If Core Scientific took a 15-year lease directly with a startup neocloud, the debt markets would balk. The risk of that neocloud going bankrupt in, say, year 5 would make financing the initial construction nearly impossible.
So AMD steps in as the ultimate guarantor. If this unnamed neocloud goes belly up in year 7, AMD is legally obligated to continue paying the hundreds of millions of dollars in rent to Core Scientific for the remainder of that 15-year term.
Exactly. AMD is acting as a financial shield. And management was very deliberate in pointing out that this credit support agreement was negotiated without any equity step-in rights.
Yes, I caught that detail in the transcript. Sullivan mentioned that other massive transactions in the market often include equity step-in rights. Why is that such a critical nuance in infrastructure finance?
Because when a massive corporation like AMD provides a multi-billion-dollar financial backstop for a smaller player, they usually demand collateral.
Right, they want protection.
Exactly. Equity step-in rights mean that if the neocloud defaults and AMD has to start paying the rent out of pocket, AMD also gets the right to seize equity ownership of the actual underlying data center asset to compensate themselves for the financial hit.
Oh, wow. So by avoiding this, Core Scientific ensures that no matter how disastrously the neocloud tenant might fail, Core Scientific retains 100% ownership of their real estate, their power contracts, and their infrastructure.
Right. It creates a perfectly ring-fenced revenue stream with zero threat of asset forfeiture. And as a component of this broader partnership, Core Scientific also issued a warrant to AMD.
Right, the warrants.
Now, while they didn't publish the granular mathematical mechanics of the warrant on the call, they did confirm the strike price reflects current market levels and it vests subject to specific commercial milestones.
And just to clarify for everyone listening, a warrant gives AMD the right to purchase a specific number of shares of Core Scientific stock at a predetermined price in the future.
Right.
So if Core Scientific executes this massive build-out successfully and their stock price triples, AMD can exercise that warrant and capture massive financial upside.
Which is brilliant because it transforms AMD from just a tenant and a guarantor into a highly motivated, aligned stakeholder. They now have a vested financial interest in seeing Core Scientific's equity value absolutely explode.
It aligns everyone's incentives perfectly. So we have established this massive $14 billion pipeline with AMD, which stacks on top of their existing multi-billion-dollar contracts with CoreWeave. This brings their total built-in contract revenue backlog to an astonishing $24 billion.
$24 billion. It's just a crazy number.
But to fully understand this earnings call, we have to look at what they are destroying to create this future.
Yeah, the legacy business.
Exactly. We are witnessing the deliberate systemic dismantling of the business that originally built Core Scientific. The death of their Bitcoin mining operation was starkly laid out in the numbers. Jim Nygaard stated their strategy is to merely optimize the legacy mining business, operating it primarily to offset contractual power costs while they wind it down.
And the metrics provided show they ended June with nearly 30% fewer miners online than at the end of the first quarter.
30% in 3 months.
Yes. A publicly traded crypto mining giant shut down almost a third of its fleet in roughly 90 days. They have consolidated self-mining operations to just 2 sites now, and the transcript explicitly guides that this wind-down activity will accelerate through the remainder of the year.
You know, you really cannot truly appreciate this pivot without understanding the fundamental mechanical and physical differences between a Bitcoin mining facility and an AI data center.
They are completely different beasts.
They both use massive amounts of electricity, which is obviously why Core Scientific has the power contracts to make this pivot in the first place. But the similarities essentially end there. I mean, a Bitcoin ASIC, an application-specific integrated circuit, is essentially just a very loud, very hot calculator designed to do one single math problem endlessly.
Right.
You can put thousands of them on cheap metal racks in a warehouse with a concrete floor, blow massive industrial fans across them to keep them from catching fire, and they will mine Bitcoin.
Because the thermodynamics and the infrastructure requirements of an ASIC facility are just rudimentary compared to AI.
Exactly.
If the ambient temperature in a Bitcoin mine gets too hot, or if the power grid suddenly needs emergency capacity, you can literally just pull the plug. The ASIC shut off, the math problem stops, and you turn them back on an hour later when things cool down.
There's zero data loss.
Zero. It is a highly interruptible workload.
But an AI data center housing clusters of NVIDIA or AMD GPUs, that is a completely different reality. A GPU cluster training a large language model is functioning as a single massively interconnected supercomputer. The chips are communicating with each other at terabytes per second.
You absolutely cannot just unplug an AI training run because the local power grid is stressed.
No. Doing so could corrupt months of continuous computational work and cost tens of millions of dollars. Plus, the heat density is astronomical. You cannot cool a dense GPU rack with just a fan.
Which is exactly why the retrofit process is so capital intensive. Transitioning a site from Bitcoin to AI requires completely tearing out the electrical distribution. You have to install sophisticated liquid cooling systems. We're talking either direct-to-chip cold plates or full immersion tanks.
And structurally, too.
Right, you need structural reinforcements for the floors because a rack of AI servers with liquid cooling manifolds is exponentially heavier than a rack of ASICs. Core Scientific is physically gutting their legacy infrastructure to accommodate the thermodynamic reality of AI.
Nygaard summarized the transition perfectly. He said they are moving from a highly volatile profile to a financial model characterized by financing capability, deep visibility, and ultimate stability.
Which is what Wall Street loves.
Absolutely. Starting next year, Bitcoin mining will basically become a negligible line item on their income statement. They are operating with a clean sheet of paper. But drawing on that clean sheet of paper costs an exorbitant amount of money.
It sure does.
Which brings us to Section 3, Management Guidance and the Future. Let's look at the financial roadmap required to actually deliver this $14 billion AMD contract. Matt Brown, the chief operating officer, provided a very transparent look at the capital expenditures required. He estimated the all-in build costs will range from $11 million to $12 million per megawatt.
If we connect this to the bigger picture, when you run the math on 530 megawatts at roughly $11.5 million per megawatt, you arrive at a total capital expenditure of approximately $6 billion, just for this initial AMD build-out.
$6 billion. And this is exactly where the retail investor needs to start asking hard questions. We established in Section 1 that Core Scientific is sitting on a mountain of liquidity, $1.8 billion on the balance sheet at the end of June.
Right.
But they need $6 billion over the next few years. There is a massive capital delta there. So what does management intend to do? Are they going to flood the market with secondary stock offerings and drastically dilute the existing shareholders to raise the missing $4.2 billion?
Dilution is always the persistent fear in infrastructure development. However, the CFO outlined a financing strategy heavily reliant on project-level bonds.
Okay, let's get into the weeds on this.
This is a mechanism made possible entirely by the investment-grade credit rating of AMD.
Let's break down the mechanics of a project-level bond for the audience. In corporate finance, project-level financing involves creating a special purpose vehicle, or SPV. This is a legally distinct subsidiary company created solely to execute one specific project, for example, the Pecos data center development. Core Scientific goes to the debt markets and borrows money through that SPV to fund the construction. The critical distinction here is that the bondholders lent money to the SPV, not to the parent company, and the repayment of that debt is legally tied exclusively to the cash flows generated by that specific asset.
Because the lenders are underwriting the 15-year guaranteed lease payments coming directly from AMD. Since AMD has an incredibly strong balance sheet, the lenders view those future rent checks as highly secure.
So they get good terms.
Very good terms. Consequently, the SPV can issue debt at highly attractive interest rates. This structure is non-recourse or limited recourse to Core Scientific. It allows them to raise billions of dollars without heavily encumbering the parent company's broader balance sheet and, most importantly, without issuing billions of dollars in new equity that would crush the stock price for current shareholders.
Okay, I understand the theory of project-level debt, but I have to push back on how risk-free this actually is because execution risk in this sector is massive right now.
That's fair.
AMD is an investment-grade counterparty, yes, but AMD is not going to start paying rent on the Pecos facility until the servers are physically plugged in and the lights turn on. What happens if Core Scientific runs into a 24-month delay because they can't source the high-voltage transformer?
The interest clock keeps ticking.
Exactly. The SPV has issued the debt, the interest clock is ticking, but the AMD revenue hasn't started. Don't the bondholders eventually look up the corporate ladder if the SPV runs out of cash during a prolonged construction delay? Doesn't that risk bleed right back into Core Scientific's equity?
That is the exact vulnerability of project finance, and it is a risk that management has to actively manage. If a project suffers catastrophic delays and the SPV exhausts its capitalized interest reserves, the parent company usually has to step in and inject rescue capital.
Just to prevent a default.
Right. Even in a non-recourse structure, simply to protect the asset and protect their reputation in the capital markets, the parent will usually step in.
An analyst on the call, Stephen Glagola from KBW, actually pressed them on the realities of the funding markets today. specifically pointing out that there has been a recent backup in interest rates and some general market indigestion regarding these massive debt issuances.
Yeah, and Adam Sullivan's response addressed the macro environment, but he maintained supreme confidence in their specific position. The mechanism at play, again, is counterparty quality.
Right. It always goes back to AMD.
Exactly. If Core Scientific were trying to raise $6 billion, backed by leases from a consortium of unproven AI startups, the bond markets would demand punishing interest rates or just refuse to fund it entirely due to the exact construction and counterparty risks you just mentioned.
But because it's AMD.
But because the debt is ring-fenced around AMD's credit, the appetite from institutional fixed income investors is immense. They're essentially buying an AMD bond with a slightly higher yield.
So the financing pathway is viable, provided they can actually build the facilities on time. As Sullivan said on the call, and I love this quote, "Value is not announced, it is delivered."
It's a great line.
Hitting delivery timelines in 2026 is an absolute operational tightrope walk. Matt Brown, the COO, broke down that $11 to $12 million per megawatt cost to really illustrate the complexity. He divided it into 3 primary buckets. The first bucket is construction labor and on-site execution. You need highly specialized electrical engineers, mechanical technicians, pipe fitters, welders who actually know how to assemble industrial liquid cooling manifolds.
And those people are not cheap.
No. Brown noted that in competitive geographies, this specialized labor pool is virtually exhausted right now, which drives up wages and project costs.
And then the second bucket is critical infrastructure equipment, which they refer to internally as owner-furnished equipment, or OFE. This is the real hardware bottleneck of the global AI boom.
We're talking about massive 300 megavolt ampere transformers.
Yeah, specialized switch gears, industrial-scale chillers, primary power distribution systems. The lead times on some of these high-voltage transformers from manufacturers like Siemens or Schneider Electric are currently stretching past 36 months.
3 years just to get a transformer.
It's unbelievable.
And the third bucket encompasses the soft costs. Design engineering, local municipality permitting, utility interconnection studies, securing temporary power during the construction phase, and just overall program management. When you aggregate the labor scarcity, the equipment backlogs, and the bureaucratic permitting delays, delivering hundreds of megawatts on schedule seems almost impossible.
Yet their track record is what secured the AMD deal in the first place. On this earnings call, they announced they had substantially completed 4 of the 5 campuses for their existing CoreWeave contract ahead of schedule.
Ahead of schedule.
Right. In a macroeconomic environment where multi-year delays are becoming the industry standard, finishing a complex, high-density AI build-out ahead of the contracted deadline is a massive validation of their supply chain management.
And clearly, AMD recognized that execution capability. For this new 530 megawatt build, the Pecos site in Texas is designated as the lead project. Management confirmed that vertical construction is already underway, early procured equipment is arriving on site, and they are targeting initial megawatt delivery to AMD in the first half of 2027.
Which is right around the corner.
It is. The subsequent sites, Hunt, Auburn, Muskogee, and Dalton, are scheduled for deliveries beginning later in 2027 and then ramping up aggressively through the end of 2028.
And during the Q&A, an analyst from Oppenheimer asked a really strategic question regarding their operational capacity. Given this massive pipeline, is there a theoretical speed limit to how fast they can actually build?
And Sullivan answered that directly. Based on the current constraints in the labor market and the realities of global equipment manufacturing, he stated their optimal target build rate is approximately 600 megawatts per year by 2028.
That represents a relentless industrial-scale cadence of deployment.
But the most staggering data point regarding their future growth wasn't even the initial AMD deal. It was the expansion clause. Management revealed that AMD holds the exclusive reservation right to lease up to 2 additional gigawatts of capacity.
2 gigawatts.
Yeah.
That is an unfathomable amount of localized power consumption. It is literally the equivalent of adding a major metropolitan footprint to the grid.
It's mind-boggling.
And this revelation obviously triggered a wave of questions from analysts regarding how Core Scientific plans to actually source the electricity for this expansion. Because the public utility grids in the United States are currently facing critical capacity constraints.
Which led to, honestly, the most critical technical discussion of the earnings call. The mechanics of behind-the-meter power generation. An analyst from Jefferies explicitly asked about grid power availability at the Pecos site, referencing an ongoing 815 megawatt load study by ERCOT.
Okay, for context, ERCOT is the Electric Reliability Council of Texas. They're the organization that manages the flow of electric power to more than 26 million Texas customers.
And the dynamic with ERCOT is fascinating because it loops right back to the death of Bitcoin mining. ERCOT historically welcomed Bitcoin miners because of demand response programs.
Right.
When the Texas grid faced catastrophic strain during a winter freeze or a summer heat wave, ERCOT would literally pay Bitcoin miners to immediately shut down their ASICs, freeing up hundreds of megawatts of power to keep residential hospitals and homes online.
But as we discussed, AI data centers cannot be shut off.
Never.
They require constant, uninterrupted baseload power. This is terrifying for grid operators. Yeah. Adding 800 megawatts of uninterruptible AI load to ERCOT requires massive transmission upgrades and years of bureaucratic impact studies.
So Adam Sullivan's response to the Jefferies analyst signaled a massive strategic evolution. He confirmed they have 300 megawatts pending in the ERCOT load study for Pecos, but he bluntly stated they are not waiting on the grid.
They're taking matters into their own hands.
Exactly. Because of the uncertainty regarding when or if ERCOT will approve the transmission of that power, Sullivan announced that the next phase of megawatts at Pecos will be driven entirely by their behind-the-meter strategy.
And behind-the-meter generation is a total paradigm shift. It means Core Scientific is bypassing the public utility transmission lines completely.
No more waiting for towers to be built.
Right. Instead of waiting for ERCOT to build high-voltage towers to bring power from a distant wind farm all the way to their data center, Core Scientific is going to build a localized power plant physically adjacent to the data center. The power goes straight from the generator into the servers without ever touching the public grid.
Matt Brown elaborated on the logistics of this strategy. They are in advanced stages of planning the construction of lateral natural gas pipelines that will tap into major interstate gas mains and run directly onto their data center campuses. They're actively negotiating with equipment manufacturers to procure the on-site generation hardware right now.
And an analyst asked a follow-up about the specific generation technology they plan to deploy, like whether they're looking exclusively at traditional natural gas combustion turbines, or if they're exploring emerging technologies like solid oxide fuel cells or linear generators.
Yeah, Brown confirmed they're evaluating a diverse portfolio of generation technologies. The specific hardware chosen will vary by site, dictated by local environmental regulations, emission limits, and just equipment availability. But the broader mechanism at play here is that Core Scientific is no longer just an infrastructure real estate company. Out of sheer necessity, they are evolving into an independent power producer.
They have to. The demand for AI computation is growing exponentially faster than the U.S. power grid can be upgraded. If you want to build a gigawatt data center in 2028, you have to generate the electricity yourself.
And management emphasized that the demand environment is not cooling off. An analyst from Clear Street asked for broader color on the sector, referencing some of the recent macroeconomic narratives suggesting that the AI boom might be, a speculative bubble.
Sullivan firmly rejected that narrative. He stated that the demand from hyperscalers, the massive cloud providers, and dedicated AI research labs remains ferocious.
He provided a specific mechanical insight into the bottleneck too, which I found so illuminating. He noted that massive purchase orders for large-scale GPU clusters are being signed right now, but those physical chips do not have a home yet.
Right.
Because data center developers across the industry are missing their delivery dates due to the supply chain issues we discussed, there are billions of dollars worth of incredibly expensive AI chips sitting in warehouses, rapidly depreciating, just waiting to be plugged in.
And the mechanism of depreciation in silicon is brutal. An AI GPU is most valuable the day it rolls off the assembly line. Every month it sits in a box, a newer, faster generation of chips is being developed.
Time is literally money.
Exactly. The hyperscalers are desperate to get these chips energized in training models. The supply-demand imbalance gives fully permitted, under construction capacity, which Core Scientific possesses immense pricing power. The hyperscalers will pay a massive premium for a facility that is guaranteed to be energized in 2027.
This perfectly explains their aggressive land acquisition strategy. Sullivan disclosed they have built a new site pipeline representing more than 2 gigawatts of potential incremental power, aiming for initial capacity availability from late 2028 through 2030.
They are so confident in this demand dynamic that they have $1 billion of capital prepared to advance roughly 500 megawatts of future capacity development before they even have a signed customer contract.
Building on spec again.
Yep. They're executing the exact same playbook that landed them the AMD deal. Secure the raw land, secure the power rights, invest the capital with extreme discipline, order the transformers 3 years in advance, get the site pad ready, and then just wait for the desperate hyperscalers to show up with a blank check for speed to market.
Wow. Okay, we have dissected the massive revenue metrics, the structural mechanics of the AMD leases, the physical realities of the pivot away from Bitcoin, and the multi-billion-dollar construction and power generation roadmap. This brings us to section 4, the bottom line.
Let's bring it all together.
Synthesizing everything we have extracted from this Q2 transcript, what is the final actionable verdict on Core Scientific for the retail investor analyzing their portfolio right now?
Based purely on the execution demonstrated in this quarter and the structural shifts embedded in the contracts, the verdict is decidedly bullish.
Okay, bullish.
Yes, though heavily caveated by execution risk, as we talked about. But the core thesis is this. Management is successfully orchestrating a fundamental transformation of the company's underlying economic engine. They are amputating a highly volatile, capital-intensive business model, Bitcoin mining, that offers zero forward visibility.
And in its place?
In its place, they're constructing a highly mature, predictable tech utility model built on 15-year guaranteed lease agreements backed by investment-grade counterparties.
They are trading the wildcat rigs for the toll road.
Exactly. The mechanism of value creation here is stability. Now, the primary variable that could derail this thesis is their ability to physically construct $6 billion worth of complex infrastructure amidst global supply chain shortages.
Which is not guaranteed.
It's not.
Yeah.
However, their proven ability to deliver the 437 megawatt CoreWeave project ahead of schedule provides empirical evidence that their internal supply chain management and construction execution are currently superior to the broader industry standard.
So, for an investor holding or evaluating the stock, the actionable advice is a fundamental shift in your valuation framework. You must stop trading Core Scientific as a proxy for the cryptocurrency markets. The spot price of Bitcoin is rapidly becoming irrelevant to the intrinsic value of this company.
Totally irrelevant.
You are no longer investing in a digital asset miner. You are investing in a specialized commercial real estate developer and an independent power producer. You are buying a slice of a company that has secured a guaranteed $24 billion revenue backlog with the titans of the global technology sector.
And the valuation multiples applied to a stable infrastructure REIT are significantly higher and more resilient than the multiples applied to a commodity miner. The market is slowly waking up to this repricing event.
Let me distill the analysis into 3 definitive takeaways from this Q2 deep dive. Number 1, the strategic pivot to AI infrastructure is not theoretical. It is physical, it is aggressive, and it is funded. They are literally tearing out their legacy crypto hardware to make room for liquid-cooled supercomputers.
Fact.
Number 2, the $14 billion AMD partnership provides an impenetrable financial safety net. Through triple net leases and full credit support for third-party neocloud tenants, Core Scientific has functionally de-risked their revenue projections for the next 15 years.
Yep.
And number 3, while the $6 billion execution roadmap is daunting and fraught with supply chain and labor risks, their history of ahead-of-schedule delivery provides a justifiable foundation of confidence for investors.
They have navigated the collapse of the crypto winter and successfully positioned themselves as a foundational pillar of the physical AI infrastructure layer.
Thank you for joining us on this Talk Ticker's deep dive into Core Scientific's Q2 earnings call. We set out to provide a data-forward, mechanical breakdown of this massive corporate transformation, and we hope you walk away with a clear understanding of the forces driving this specific ticker. But before we sign off, there's one final broader implication of this earnings call that warrants your consideration.
Yeah, this raises an incredibly provocative question regarding the future of digital energy. Core Scientific is demonstrating that dedicating a megawatt of power to an AI GPU cluster is vastly more profitable, more stable, and easier to finance than dedicating that same megawatt to a Bitcoin ASIC.
Right.
So if the financial markets and the debt underwriters universally agree that AI colocation is the superior business model, what is the logical endgame for the rest of the market? How long until the entire publicly traded cryptocurrency mining industry is systematically acquired, gutted, and swallowed up by the insatiable demand for AI compute?
It's a huge question.
If every large-scale power contract on the grid is objectively more valuable when serving an AI workload rather than a Bitcoin workload, are we witnessing the beginning of the end for independent, publicly traded crypto miners?
It is a profound structural question to consider as you watch the sector evolve. Keep an eye on the actual mechanics behind the headlines, stay curious about the shifting value of power, and we will catch you on the next deep dive. Remember the lesson of the wildcat driller. Sometimes the most lucrative strategy isn't chasing the unpredictable gusher, it is securing the concrete, building the road, and collecting the toll from everyone who has to drive on it.